Welcome back to the Deep Dive. Today, we're digging into something a lot of traders are curious about, prop firms.
Right, specifically Apex Trader Fundings. Big name out there.
Huge. And the promise is, well, it's really tempting, isn't it? Get funded, trade their capital, keep most of the profit.
Exactly. Up to 90%. That's the headline that grabs everyone.
So our mission today is to figure out, is Apex a genuine fast track, or is it more like a trap for traders who might be a bit too confident? We've looked at their pitch and some user experiences.
Yeah, and the pitch itself is slick. Apex really highlights this one-step evaluation. Pretty simple on paper.
What are the main points there?
You just need to hit a profit target, make sure you don't fall below the drawdown limit, and trade for at least 7 days. That's it.
Okay, sounds straightforward enough. And the profit split you mentioned.
That's the big carrot. They say you keep 100% of the first $25,000 you make.
Wow, all of it.
For the first bit, yeah. Then it shifts to a 90-10 split. Still, 90% is massive in this industry.
Plus, I saw they allow trading during news events. That's often restricted.
It is. And some plans don't have those tricky scaling rules, where you have to build up contract size slowly. Plus, you can apparently run up to 20 funded accounts at once.
20? Okay, that's wild.
It offers a ton of potential leverage. And look, on the surface, things look pretty solid. They've got a, 4.5 on Trustpilot?
Yeah, over 10,000 reviews. Lots of comments praising quick payouts, good support. Initially, anyway.
Right, so based on that data alone, you'd think, okay, seems legit.
Okay, so that's the shiny exterior. But we're here for the deep dive, right?
Sure.
Where do the cracks start showing, especially when people actually start making decent money?
Yes. This is where it gets really interesting and honestly a bit concerning based on some accounts. It seems like the rules get, well, let's say, flexible, or maybe opaque is the better word.
Flexible in whose favor?
Exactly. It often seems to happen right when a trader starts pulling in significant profits. We found this one really specific, detailed account. A trader had a big payout denied, like $16,500.
16 grand. Ouch. What was the reason? Did they blow the drawdown?
Nope, that's the thing. It wasn't a typical rule break during trading. The denial came down to a rule about DCA dollar cost averaging.
Okay. Averaging into a losing position.
Right, increasing size as the trade goes against you. Now, prop firms hate that. It's true. It screams risk to them.
Sure, I get that. But was that rule always clear?
Well, here's the kicker. This specific rule, or at least its strict enforcement, was apparently brought in after this trader had already passed the evaluation. It was applied retroactively.
Wait, so they passed under one set of rules, made money, and then got denied based on a new rule applied to their past trading.
That's what the account claims, yeah. The issue isn't even whether DCA is bad strategy, it's the stability of the contract. The rules changed, or the interpretation did, after the fact.
That feels really unstable. Is this just a one-off story, or are there patterns?
It doesn't seem totally isolated. We saw other complaints echoing similar themes, things like profit withdrawals getting held up for ages.
Delays, okay.
Yeah, or people being told they violated a rule, but the explanation is super vague, no specifics. And then, poof, support suddenly becomes much harder to reach.
So the support that was initially praised kind of vanishes when there's a dispute.
That's the reported experience in some negative cases. So look, it doesn't mean Apex is an outright scam. Clearly, some people do get paid. We see those reviews too.
But it's a high-risk game.
Extremely high stakes, yeah.
Right.
You're basically betting that the rules and how they interpret them will stay consistent, and the sources suggest that consistency can wobble right when you're winning big.
Okay, so let's bring this back to the listener. If someone hears this and is still thinking about trying Apex, what's the practical advice based on these accounts?
The sources are pretty clear on precautions. First off, don't go all in. If you try Apex, just run one evaluation account to start. Treat it like a text drive.
Test the waters, basically. Makes sense.
Absolutely. And trade like a robot. Follow every single rule to the absolute letter. Assume there's zero wiggle room or goodwill.
No spirit of the rule stuff.
None. And, crucially, document everything. Keep records of your trades, maybe even screen recordings. Save all your communications with them.
CYA, basically. Cover your assets.
You got it. And then, if you pass and get funded, test the withdrawal system immediately. Try taking out a small amount of profit right away.
Just to see if it works smoothly.
Exactly. See if the process is as easy as they say before you've built up a big balance. Verify it works.
Right. Because that potential 90-10 split is still a massive draw. But this deep dive Really highlights the hidden risk, doesn't it?
It does. The risk isn't just about your trading skill, it's about the stability of the agreement itself. Can the terms change after you've already won by their own rules?
Hmm. So the final thought for you listening is this. How much potential reward are you willing to chase if the goalpost might move just as you're about to score? Something to think about. Keep questioning. We'll catch you on the next deep dive.